Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Following the events surrounding the collapse of the Silicon Valley Bank in the US and the takeover of Credit Suisse by UBS, over recent days, markets' focus has shifted away from the risk of a systemic banking crisis towards the implications for bank lending. Even prior to the banking sector stresses surfaced in the US and Europe, credit tightening was already in place as indicated by central bank lending surveys. For instance, the share of euro area banks that made their lending standards stricter rose during Q1 2023 to its highest level since 2011. In the US, the share of domestic respondents in favor of tightening standards rose sharply too, but to its post-pandemic high. However, the banking sector stresses have increased the prospects of further credit tightening as both willingness and ability of banks to lend is reduced. A further question is to what degree regulators will move to curtail banks' lending ability. Against this backdrop, the real estate sector has become the newfound hotspot. The commercial real estate industry, CRE, could be negatively impacted by the banking sector stresses in two different ways: of impaired lending and reduced buying of senior tranches of securitization. Especially in the US, regional banks, which have been the source of crisis, have sizable exposure to CRE market. Retail banks' exposure to CRE lending has grown in recent years, with 70% of the core CRE debt now coming from regional banks. These linkages become more important given the non-amortizing nature of CRE mortgages, which tend to be of 5 to 10 year terms. CRE also has imminent refinancing needs. For the context, as per Morgan Stanley, $450 billion out of the $5 trillion in total CRE debt matures this year and needs refinancing. A total of $2.5 trillion CRE debt is set to mature over the next 5 years, and 40% of this comes from banking sector. Given the recent fall in capital value of real estate, refinancing might prove problematic for some, especially for those that have extended loan to value ratios or limited free cash flows post debt servicing. For example, investment manager AEW estimates that in the UK, France, and Germany, between 2023 and 2025, there will be a shortfall of 24 billion euros between the amount of debt due to be repaid at maturity and the amount of new debt available to repay it. Further, delinquency rates are also on the rise. Sectors like retail and offices, which contribute circa 64% of the credit expiring this year, is also where the delinquency rates have been high in 2022. Let's shift gears a bit and look at the residential mortgage market. Residential mortgages, compared to business loans or commercial mortgages, might see more muted impact from the banking sector stresses. There are three reasons behind this. First, as per Goldman Sachs estimates, only 18% of these mortgages are non-securitized. This makes the mortgage lending less sensitive to bank balance sheet pressures. Second, mortgage industry employment remains high relative to the origination volumes, indicating spare capacity at the lenders. Third, the FRB Senior Loan Officer Opinion Survey points to already tightening lending standards. In summary, banking sector stress comes at a time of acute refinancing needs of the CRE sector. This should put additional pressure on CRE prices. Office sector, where vacancy rates are at or near all-time highs, is likely to face cash flow interruptions and a potential fall in property values. Residential mortgages might be the least impacted in this category. Gap between residential mortgage rates and treasury yields have widened over the recent weeks and could remain wide as banks remain selective in lending. Public market real estate segments have reacted much quicker than private markets as usual. However, lower interest rates will remove a major drag on the asset class overall. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.